Are you in the process of trying to buy a home but have some issues or changes when it comes to income and employment? Well, that's exactly what Josh and I are going to dive into today as we discuss the intricacies of employment, what a lender looks for, how they look at your income, how they average it, when you have changes, when you have gaps, when the situation is just a little messed up. So Josh, you deal with a lot of people that are, on the pre-approval side where, you're getting questions around income and employment. So let's take some time and talk about it in detail.
We get a lot of questions about, hey, I have this situation. I had a gap of employment. I just switched jobs. Can I switch jobs? I was self-employed. I took a job. How does this impact? So let's start, Jeb, at the 1,000-foot view. And what does an underwriter look for? And what do they care about when they're going through your income? First of all, they want to see a history, right? They want to see that you didn't get your job last week. Great. You got a job last week, $1 million salary. We don't have a history of that. We don't know that that's going to happen. So we want to see stability. So we want to see that from year to year, you're not making more or less big variations that they can't depend on. And they want to see continuity, that it is likely to continue in the future, because the most important thing is they want to know that you have enough stable, dependable income to repay the loan they're approving for you for.
Now, you said continuity. You sure it's not continuity?
It is continuity, sir.
The only reason I'm asking that is because I screwed that up, guys, if you're listening to this. But no, in all seriousness, I want to take a step back, Josh, because what viewers, what listeners see when it comes to employment and income is that a lender wants 2-year history. So you said they want a history. You didn't go into time frame. So let's talk about that continuity, that stability of what does a lender want to see when they're talking about history of income, and or employment rather.
Before we go into any of the details, Jeb, let's step back. And what I want all of you to know, there are guidelines. For the most part, these are guidelines. They are not hard and fast, bright lines that it is A or B, pass or fail. And remembering that there are multiple aspects to the strength of a file. A borrower putting 50% down is going to be given a lot more leeway than a borrower putting 3% down. A borrower with an 800 credit score is going to be given more leeway than a borrower with a 600 credit score. And a borrower that's going to have $1 million in the bank post-closing, much more leeway than the person who's using every last nickel to close their loan. So think in terms of that. The strength of you in every other area is going to give you more leeway in the employment. And we're going to be going through the guidelines. So what I like to say is I very rarely ever tell someone no on the phone. No, that doesn't work. If you tell me you've never worked in your life and you got a job yesterday and it's 100% commission, I'm going to tell you no, we cannot do a traditional loan with that. But for the most part, when people are calling me with questions, it's either, okay, tell me this, this, and this. With all of those things, if we can document them, you're fine. Or tell me this, this, and this. We should be okay, but let me go out to an underwriter and verify that ahead of time. No one should be telling you, for the most part, unless it is just a hard and fast, pure no, no one should be telling you no on the phone. They should be asking for more information and going and confirming for themselves or confirming with an underwriter. So when we talk about that history, and we want to see a 2-year history. Does that mean you have to have a 2-year history? No, we have exceptions for that. Jeb, some pretty simple ones. If you just graduated college yesterday, or even if you graduated high school yesterday, well, you were getting educated. And now with your high school diploma, with your college degree, with your AA degree, with your welding certificate, you are now eligible for this job. So if we document that, the education becomes a part of that history. And that 2 years is 2 years hard and fast? No, it's not. But if you had the job for 2 weeks, it's going to be very hard to use. Once we get over a year, if it's an otherwise strong file, we start to have a case for it. At 18 months, we have a really good case for it. Once you get really close to 2 years, if we're at 22 months and you're into a 30-day escrow, by the time we get to close, you are going to have that 2 years. So for the history of it, it's almost the least important. It is important, and there are some hard and fast rules in there, but there is a lot of flexibility for otherwise well-qualified borrowers.
Now let's talk about the stability piece of that, right? So let's say I am employed for, a part of that 2 years, but then I've got some gaps. I moved and it took me a while to find a job. I had, something happen, wife had some health issues. I needed to take some time off, pandemic related stuff, whatever it is. I mean, we can come up with a number of like real life cases where people contact us, but how is a lender looking at that history when you've got, these gaps between jobs, you're changing jobs or whatever?
So remember, it's a sliding scale based off of the rest of the strength of your file. Let's start with the easy one, the one that does have a hard and fast rule that I don't know that there's any way of getting around it. If you have a job gap of more than 6 months, FHA wants you back on the job for 6 months. So you're out for 6 months, you need to be back on a new job that is in similar line of work, similar pay, and be on there for 6 months. Fannie and Freddie are not nearly as restrictive on that. They want you back on the job. They want a really good explanation. I mean, you gave some very good examples. Lots of people lost their jobs during COVID. So we come out 6 months later, you get back on that job in similar pay, similar type of industry, similar job title. We would have been okay, Fannie and Freddie. And I'm sure that FHA was maybe giving some lenience during that COVID timeframe. But for the most part, we have options, but they want to see stability in terms of we don't have gaps of employment. And the big one, Jeb, that we get people asking all the time, hey, I've had 3 jobs in the last 2 years. Or they say, okay, I'm on my second job and I just got offered an even better job making twice as much money, but I need to wait to take that job until after we close, right? That is never the case. If you are making lateral moves or moves up the ladder when you're changing employers within an industry, similar jobs or advancing job titles with increases in pay, that's never going to be a problem for you.
No, good stuff. And now what happens when you're changing? Now, some of this stuff is going to kind of commingle, if you will, Josh, with income. But what happens in the situation where we're on a job and we're a 1099 employee? So we're commission only. I'm a real estate agent, for example. I'm only getting paid commission. And I say, you know what? With all the changes, I'm out of here. I quit. I'm being serious. I'm done. No. And then I decide, you know what? I'm going to go work a W-2 job. Is that change in employment there okay? And can you go the other way?
You used a really difficult example because you as a realtor, if I'm self-employed 1099 realtor, there aren't really salaried realtor positions out there. You know, some of the discount brokerages, maybe you get a $30,000 salary. You're going to have commissions and variable income in there. It's be very difficult to use. But if here's probably a better example. You're an independent truck driver. You get assigned loads and you get paid 1099 for those loads. And you go, this is for the birds. I hate this. I'm going to go drive for this company. They give me a truck. I show up, I punch a clock, and I get paid those hours. As long as we know we've got full 40 hours at $40 an hour, whatever it is. And that can be also a dicey situation because some of these people are paid per mile unless we have a guaranteed mileage rate from your employer. So what you probably should be hearing at home is, every situation is different. So people ask me a question and sometimes they'll get upset. Why are you asking me a bunch of questions? I just asked you a question. I want a yes or no answer. It's not a yes or no answer. It's peel away the onion, get all of our cards on the table and figure out, can we make this work? For the most part, lenders want to make loans. They want to see things in your favor, but they have to make sure it meets the agency guidelines. They have to make sure they're not putting you in a position where you're going to have an early payment default where they have to buy that loan back and they have something that's worth much less money than the loan that they put on the books.
Now, maybe you answered it in a way that I didn't understand, but I've heard, Josh, that going from a W-2 employee where I'm actually getting a regular salary, and then I decide to become a commissioned employee, so I'm no longer getting a salary at all, that is a problem. Is that the case, or is there still an option for that to work out?
Jeb, you're acting like a typical borrower here. You're bouncing around, commingling issues.
Well, I asked the question a moment ago, and you skated around it. So
no,
I'm asking it directly.
They're literally different issues. So let's go back. Going from being 1099 to W-2, as long as we have a fixed income that your employer will guarantee, is not a problem. Now going W-2 to 1099, totally different animal, because we don't have a 2-year history of it. A 1099 employee, you are not getting wages, you are getting gross income. And whether you're a sole proprietor, whether you set up an LLC, that money is going to go top line over to your tax return. And you're going to say, I had business mileage, I had meal and entertainment expense, I had to have insurance, I had any number of expenses. So we need a 2-year history of that to determine what is the bottom line and what is the qualifying income, not the gross income. A 1099 is very different from a W-2. W-2, we assume that an employer that gives you the W-2 is taking care of all of the expenses incurred in you generating that income. As a 1099 independent contractor, you have expenses and we have no idea what they are. I saw a Schedule C yesterday. Borrower might have had $4,000 total over the course of the year in business expenses. I saw another one for S Corp, individual owner. He had $850,000 of expenses. So that's why an underwriter wants to see that 2-year history. Can we use less? So this is an interesting one, Jeb, in that until very, very recently, we would answer, if we're talking Fannie Freddie loans, Fannie Mae, it's going to be determined by the automated underwriting system. Freddie Mac says if the business has existed for 5 years, we can get 1-year tax return. Less than 5 years, we need 2 years tax return. So if you're switching, if you're W-2, you set up a business, you're only in business for 1 year, we need 2 years tax returns. We need that 2-year history. It's not bright line, hard and fast, cannot be done, but very difficult to get someone qualified for 1 year. Well, very recently, Jeb, news to me, just in the very recent past year, Fannie Mae is following Freddie Mac guidelines. 5 years, 1 year tax return. Less than 5 years, 2 years tax returns. And to me, that's silly. How long the business exists. I've seen businesses that have been around for 18 months that are massively profitable. And I've seen businesses that have been around for 10 years that can't make a profit. And so the thing that they're looking for, again, going back to stability and likely continuance of that income, that's why they want to see 2 years. They want to see that this business multiple years has put up a similar level of income, a similar level of expenses, similar level of net income. And you're losing that. To me, it's kind of arbitrary to say that a business has been around for 5 years, can document that with 1 year, and anything less is 2 years. But that's where we're at right now. So answers to the question you asked and one you didn't even ask yet.
No, and that's good. I mean, you started talking about unemployment, which is exactly where we're going. And that's exactly what we're going to dive into right after you guys hit the thumbs up if you find any value in content like this at all. And if you want to continue to stay updated on, everything happening in the mortgage and real estate industry, changes that might affect you as a buyer or seller, do us a favor and subscribe to the channel. So Josh, you mentioned income there and talked a little bit about stability of income. And in a similar fashion, it kind of follows what we talked about with regards to employment, but let's break it down in a little bit more detail. So when a lender is looking at income, how are they taking that income and with consistency, again, stability and continuity, if you will?
I have borrowers all the time, every day. They come and say, I make X. And I say, cool. I do not doubt that you make X, that next month, that is what is going to come into your bank account. That's what your pay stub is going to say. That is not your qualifying income. The underwriter is responsible for following the guidelines and giving you the qualifying income, which is the income that they know is stable and likely to continue going forward. So where can that differ? Let's talk about the stuff that's super simple. We have a borrower that's salary. I make an $80,000 annual salary, and I look at each pay stub, and it's 1/12 of that once a month. Boom, there you go. Super easy. And if you get a new job tomorrow, you had the old job with $70,000 salary. We start the new job tomorrow, $80,000 salary. Even though we have to have 1 to 2 years of W-2s in the file, don't get hung up on that. We don't care. You are salaried. We are looking at the income that you make today and are being told by your employer going forward. We're not looking back on that. So when do we look back? And I guess to close a loop on that, Jeb, hourly is not different. Whatever $80,000 a year comes to in an hourly rate, if you get $50 an hour, you work 40 hours a week, that's $2,000 a week. You make $104,000 a year. That's no different than a $104,000 salary. So do not get hung up on that. The big determinant there is we have to look at your pay stubs. We have to look at your year-to-date pay and the last couple of years W-2s to confirm that, do you really work 40 hours? I have people who say, hey, I make $50 an hour, I work 40 hours. And I go, well, you've never made that much on a W-2 and none of these pay stubs show 40 hours. One does, but one's 32 and a half hours. One's 37 hours. So when we look at that, when it doesn't tell that story, now we have to average that income because you're not consistently working 40 hours. We also have specific types of income. That same borrower, maybe they do get $50 an hour, 40 hours, but they work some overtime also. And our ratios are tight, so we're trying to give them credit for that overtime. Well, the overtime is variable. Unless your employer says, hey, Jeb works 50 hours a week and 10 of those hours are overtime, always works it, it's guaranteed, he's expected to work it going forward. If we get that on a verification of employment, we can calculate that. Otherwise, we need to go back 2 years 2 years W-2s, year to date. Maybe we can use last year and year to date, but we need to get an average of that income going forward. So that also applies to bonuses, commissions, overtime, anything that's variable, that is not set in stone, that you don't know what it's going to be next month, could be massive, could be minor. We have to go back in time and get an average of that to determine what is the most probable amount of monthly qualifying income you will have in the future to make your monthly mortgage payment.
And I want to stress something if you're listening to this. That's why it's super important that you're actually going through the pre-approval process versus a pre-qual, right? The pre-approval is you're providing documentation off the conversation that you had with your lender, like Josh. For example, you have the conversation, say, Josh, I make $100,000 a year, and Josh just doesn't take that $100,000 and put it in the application and qualify you based on that. He sees the documentation that goes along with it and says, yeah, you make 100, but based on this, this, and this, we can't actually use it for whatever reason, right? And it's super, super important because oftentimes, more often than not, I would say, Josh, and you can confirm or deny that, is that the income does vary from what people actually think they make on paper. So if you're going through that process, just make sure you take the extra step, provide the documentation, let the lender look at it just to make sure there's no hiccups in the file and that you're good to go. And if you want to work with Josh and our team here, just do us a favor. There's a referral link in the description of this video where you can get in touch with us. You can ask Josh directly, these types of questions and ultimately get guided in the right direction. And if you're not here locally, you can work with one of our partners in the other states that we're not licensed in. So Josh, we've talked a little bit about that. Now let's take it a little step further and talk about variations when it comes to different types of programs. Does income vary in how it's looked at versus FHA, conventional, USDA, all that good stuff?
There are some minor variations in terms of documentation requirement. So if Fannie Freddie will let us use 1 year, it kind of gives us a little bit of wiggle room there. But for the most part, they want a 2-year history of your work, a 2-year history of your income to make sure we have a stable or increasing income trend so that they are comfortable that you're not just making that money today, that you're going to have that job tomorrow, next week, next year with a similar rate of income to enable you to pay back the mortgage that they're qualifying you for. So are there subtle differences in all of these? Absolutely. One of them here that kind of surprised me in going through the guidelines, USDA only requires a 1-year history of a second job. Every other loan program, the guidelines say 2 years. We might be able to get away after 1 year, definitely after 18 months, have a good chance. But little subtle differences like that, but nothing that in the context of you educating yourself through podcasts, YouTube videos, reading on the internet, nothing that you're going to be able to know those guidelines. It's stuff that is minutia in the details between those different programs that we as lending professionals have to be aware of to walk you through that.
Well, I don't want to let you away too easy on that. So second job is something we hear a lot of. Side gig, right? I drive for Uber. I'm a content creator. I get paid by YouTube. These are things where you're talking about that you cannot use that income if you're doing a Fannie Mae, Freddie Mac loan without a 2-year history. Is that right?
Jeb, if I didn't know better, I think you're playing stump the joke man here. You're combining issues, you're adding multiple questions.
Hey.
So let's separate them and go through the first one. A second job. I work at Amazon 40 hours a week and I make $32 an hour. I also happen to work at Best Buy every weekend and I get 2 6-hour shifts for 12 hours at whatever the hourly rate is.
You're a busy man.
Can we use that? Depends. We need the 2-year history of it, or at least very close to it. And why is that? Say Josh didn't qualify with his Amazon job. So he goes, I got to buy a house. I got a kid on the way. I got to do it. I'm going to run down to Best Buy, pick up some hours on the weekend. I'm going to get my home. Then I'm going to quit that job. So that is why the 2-year history of the second job is required. Obviously they know that you work. It's just a matter of, are you committed to working more than 40 hours a week to be able to repay that loan? Now, that second issue of, cool, I work at Amazon 40 hours a week and I got a side hustle on the weekend. I have a car detailing business. Cool. Now, just as you asked, you are 100% correct, Jeb. That falls back to the self-employment guidelines. Can we use it? Absolutely, we can use it if it meets the self-employment guidelines. So if you just started this a year ago, they're going to ask for 2 years tax returns. We don't have a 2-year history of it. You're in trouble. If you started it 2 years ago, 2.5 years ago, so we have a 22 and a 23 tax return, cool. We can use the income there. But what I hear from a lot of people is, yeah, I got a side hustle. I make about 25 grand, and I get it. And it says, I brought in 25 grand, but I lost $32,000, and I use that to offset my W-2 income, and I get a giant tax refund. That's how I have a down payment for buying a house. That's not going to help us, which also then takes us to another question, Jeb. Can we ignore it? Sometimes we can. So if you have that W-2 income, and to use that, all we need is a pay stub and a W-2, we don't have to provide that tax return that shows today, for the time being, you have a business that on paper says it shows a loss. And the belief from the lender is that's not fraud. You're not hiding anything. The belief is if you have a business that's creating a loss that's going to make you lose your home, you'll shut the business down and stop that loss and just focus on your primary job. So hopefully kind of went and answered three questions.
It's
two
good.
that you asked.
No, and the reason, again, these are the questions that we hear. I mean, as a lender for over 10 years, I mean, I got the same questions back then as we're asking now to some degree. Guidelines have changed a little bit because side hustles are way more common now than they've ever been. Second jobs, similar fashion. So now let's talk a little bit about how income varies, how a lender looks at it. I could combine a couple things here too. But we'll kind of let you just take the role here and talk about what does average income look like, or how do they average income? What happens when income varies from year to year? It goes down, goes up. Are you able to use the new income, or, again, I'll let you kind of just take the lead and explain.
Let's use a very simple one of variable income that has to be averaged. Actually, this example is a listener to the show. A couple in Pennsylvania reached out. You got us connected. Going through it, they weren't happy with the B of A person that they were dealing with. And as we go through it, they were able to send me over their final pay stub from the last 2 years. Because we said, we have bonuses. Cool. We need to average that. And they send it over. And both of them, almost within a couple dollars every year, it's a $5,000 bonus for both borrowers. So cool. We have a $5,000 average for each of them over the last 2 years. We've shown that we've received it for 2 years. It's stable. It's not decreasing. It didn't shoot to the moon 1 year. So we added about $425 a month of additional qualifying income for them. Now, let's look at a situation where it might have been a problem. What if in 2022, one of them got a $20,000 bonus, and then in 2023, we had no bonus? Well, now we're in trouble. We can't use it. I don't have a 2-year history of receiving it. Use a different example. They have a $20,000 bonus in 2022, and I got a $2,000 bonus in 2023. That's declining income. I probably need to get something in writing from the employer as to what happened, why the bonus was lower, and what it's likely to be, or what it's expected to be for the coming year. And we're most likely only going to be able to use that $2,000. We don't have to average it over 24 months. We have to average it over 12 months. What an underwriter is looking to do is say, what is the most conservative number that I know for a fact this person is likely to receive over the next 12 months so that they will be able to make this mortgage payment? And the same thing goes for commissions. Jeb, you and I have a client here. We just closed last month where we had an issue where 2022 was a very high level. 2023, they lost one of their biggest accounts and it went down. Year to date, it is lower still. And he's like, hey, it's not a problem because I have another big customer that will more than replace the one back from 2022, and I'll be making more money than ever. Well, from an underwriter's perspective, they're looking at this and we're at 60,000, 40,000, and this year we're on pace to do 20,000. That is a problem because we have a straight declining path. And even with that, where if you read the guidelines, that is a brick wall. You're dead in the water with a Fannie Freddie guideline, FHA, VA. We were able to get that done because it was a very strong file otherwise. So kind of going back to the other portions of your file, borrower had an 800 credit score. Post-closing, we have $1 million in the bank. Underwriter looks at that and says, I'll give this person some leeway where someone's using up all their money and putting 3% down is probably not going to be given the same amount of leeway. No,
good stuff. Now, I'm going to ask a double part question again here, Josh, when it comes to types of income. So one of the questions that we often get is, can I use Social Security? Can I use disability? So, these different income sources, can I use my pension, if you will, to help me qualify when you have another job? On the same lines, can you actually have no job at all? Zero job, no employment, be receiving income that is a reliable source of income and use that to qualify?
So let's start with that last part because that's easy. Lender doesn't care what you have to do to get that money. They care, is there a history of receiving it? Is it stable? Is it likely to continue? So let's go back to pension income, Social Security income, VA disability income. We deal with a lot of veterans. A lot of veterans have disability ratings, and they get anywhere from $300 to $4,000 a month of income. If it's a pension, if it's Social Security, and you just turned 65 yesterday and started getting your first check, I don't need a history of that. We know it's going to continue going forward because you meet the eligibility requirements. If you didn't have a VA disability rating and you get it, and this month you got your $400, we know that's going to continue into the future. So history is less important. What we need to know is that you are going to get it and it is likely to continue into the future. So lenders do not care about the income source. They don't care if it's earned income, if you're going to go out and earn it, or if it's given to you off of something that you have earned through work history, through disability, any of that stuff. And in terms of not having a job, they don't care. They don't care what you do during the day. They care on the first of next month, is enough money going to come in to pay our mortgage? And whatever those sources are, we're talking specifically about employment and income today. But if it's capital gains income, dividends, interest, all of those can be used, but they have guidelines for when they can be used to determine that we have a history of it, it's stable, and it's likely to continue.
Now I'm looking through our outline, Josh, and I went completely out of order, if we're completely honest. And I'm getting down to the question part of the episode where I went through, kind of outlined some questions that we would get. A lot of those we've addressed, but there's a question that has come up, or I've had clients in the past that have been in a similar situation. So I'm going to kind of go off topic here and say, what if I have no job, zero job at all, but I have money? I have plenty of money in the bank. And you look at that money and think, this guy's got enough money to be able to buy the house outright. He's not putting it all down. He's putting, say, 15, 20% down. Is that a reliable source, having assets in the bank to be able to compensate for not having a job? Or does employment still stand at the top of that list?
Post 2008, the government responded with Dodd-Frank. As part of Dodd-Frank, we have what are called the ATR rules, the ability to repay. No one can make you a loan without documenting your ability to repay. So an option for something you're talking about is like an ATR in full. If you're borrowing $1 million, but you have $2 million sitting in the bank, there are lenders out there, much like a bank statement loan for alternative documentation, that they'll say, we will accept the fact that you could write us a check and pay the whole thing off as your ability to repay. It's very hard under the guidelines today, and this is a good thing, to do a true stated income or no employment loan. But those lenders do exist. We had 2 or 3 of them. Now I'm only aware of 1 or 2. But what do they require? Very good credit, very big down payments. So it almost always goes back to, how strong are you on the whole? If you have $100,000 in the bank, you're asking for a $500,000 loan, you can't document income, and you got a 600 credit score, not going to happen. But for a very well qualified borrower, yes. If you're talking about buying an investment property, you can do a debt service coverage ratio loan where the rents that the property generates is used as your ability to repay. If you're self-employed, your tax return shows I'm that guy that loses $25,000 on paper, but the bank statement says $125,000 a month comes in. We can credit you with a good chunk of that income to qualify in lieu. So the thing to remember, 98% of the time, we're talking Fannie, Freddie, FHA, VA, USDA, and jumbo guidelines here. We're getting outside of that to non-QM loans, alternative qualifying things. And the important thing to remember, when you go and look at Optimal Blue or Mortgage News Daily and you see what the interest rates are, those are not the interest rates for those loan programs. You are going to pay a premium. If you have a small loan to value, a massive credit score, and a bunch of money in the bank, it may be a small premium. The further you get away from that ideal profile to the lender, the more of a premium you're going to pay. Sometimes it's going to be 3-4% above what the market is for a Fannie Freddie loan.
And that's something we really didn't get into. We didn't talk about bank statement loans. We didn't talk about hard money. I mean, there are different variations out there of loan programs that if you have enough money, there are alternative solutions for you. But for the majority of our listeners, first-time home buyers, we're talking the basics, right? Fannie, Freddie, USDA, VA, FHA, that sort of thing. But Josh, I think that gives people a really good view of what we're talking about income-wise. Can you think of anything question-wise that you get that we haven't discussed in detail where people, come up around that income and employment front?
No, I don't think there's anything that we didn't go over. I'm sure there are multiple specific situations. So everyone will call and say, okay, listen to the episode. Sounds like you know what you're talking about, but we didn't talk about my issue. And we go back to it and we go, well, we got pretty darn close to it, but not exactly what your situation is. So I always fall back on absolutely important that you get competitive terms. But what we often get on the inquiries from people, hey, what's important about this loan to you, or what questions you have? Just want to make sure I get the lowest rate. Okay. I talk to people all day, every day, 2 to 5 people a week telling me that they're in a pickle, painted into a corner, got an email this morning, want to know, hey, can you help? Can you bail me out on this? Paid for an appraisal, paid for a home inspection. I'm $1,400 into this. And the lender's telling me now I don't qualify. And I go back and look at my records. I go, it's really weird. We had 14 text and email exchanges and we were going to work on a pre-approval. This person disappears. So it's self-serving to say I'm the answer. I was on I do Vetted VA Live every Tuesday. I was on with 3 guys and the conversation we had is, you're not my competition. The people that are calling me having problems didn't get to another person like you. So we talk about 80-20. It's worse than 80-20. You have more than an 80% chance of getting to someone that's new, inexperienced, unprofessional, unknowledgeable, unskilled at their job, and lots of little details here. I had that situation with a listener to the show this week, and I told him, I go, listen, your loan is so easy that the person you're choosing to go with can't screw that up. So I'm not worried that you're going to be one of these people calling me at the 11th hour. Some people are. And you're like, hey, I hate to tell you, this is not going to go the way you expect. But a lot of people, your loan is so easy that it doesn't matter. You're not getting into arcane details like we just went through. But for most people in the current market, 50-60% of our loans have tricky issues that we're working through. And people want to make phone calls and find out who's going to give them the lowest quote. It's a recipe for disaster. And truly daily, I talk to people. I shouldn't say truly daily, multiple times a week through text and phone calls. I talk to people. Can you fix this? Or is it too late? How do I get out of this?
No, and you, well, in your storytelling there, you're leaving out the climax here. Are you able to actually help the person who messaged you this morning that can't get it done with the other lender?
No, because that was an easy no. So there's 2 things that you can get that are incorrect information from a lender. A false yes is worse because you get further into the transaction and you've spent money. A false no, big picture, may be worse because you're sitting at home going, I don't qualify. I can't buy a house right now. And so I got to put my dreams on hold. You determine which is worse. But that one where you get a false yes, it was a 5-minute conversation and it's not them. They qualify. They tried to buy a property that's commercially zoned and they can't get insurance that is acceptable to the lender. 2 weeks ago, we did an episode on insurance. Insurance is really important. If you tell me, hey, I have a property that has mixed use zoning, we're going to jump in and we're going to ask a lot of questions very early in the process. We don't go, hey, let me get the appraisal ordered so you're locked in, so you don't go shopping for the loan, that you're going to stick with me and we'll find out later on if I can do the loan. And if so, fantastic. If not, you're screwed.
Yeah. So how do you avoid that? You talk to a professional from the start. If you need one, want to get connected with our team, there's information in the description of this video. But next week, I don't know what we're going to be talking about, guys, but we're going to come to you with a really good episode to continue educating you in becoming the educated home buyer. So until then, adios.
Amigos.